Hi, everybody. This is Kevin, and we're going to talk about the third quarter of 2019. But here are the messages that I want to convey in this video. Number one, Q3 was not that hot of a quarter, except REITs did fantastic. I'll go over that. Bonds did great. US stocks did okay. When did the returns show up in 2019? So they didn't show up in the third quarter. So I'm going to show you when they predominantly showed up in 2013. Now here, right here is the greatest key to investing. It's so simple, but most people don't get it. But stop the madness. There was a lady on TV, I don't know, 30 years ago. She had white hair and it was all spiked up, and she would just get on there, stop the madness. Stop the insanity. Well, today, with the smartphones and everything else, we can get really upset about investments. We can check our investments every moment. But I'm going to share with you the evidence about when we expect returns to be positive with stocks over bonds. So if you're going to be investing in stocks, when do we expect that stocks will do better than bonds? Because there are going to be a number of years when bonds will do better than stocks. And if you don't want to be disappointed, it's actually 10 years. So what I would suggest is that if you're going to put money into any stock markets, that money should stay in that investment for 10 years through thick and thin if you want to get a positive return. Now, you could try to time the market. And I will share with you in the slide deck, there's a slide on timing the market and just how futile it's been in the past. And that's the reason why we don't do it. But if you put money in and you are willing to wait 10 years, you're going to get a positive return, at least historically. We can't say for sure in the future, but we can say that you're probably going to have a better return. I use the word probably because there's no guarantees. So 10 years, that's really the secret to stock investing. And if some of you are saying, well, I don't have 10 years, well, you can put money in other investments such as bonds, cash, CDs, other places where you know you're going to get a positive return, but you're not going to go for the big returns that you can get in stocks. So, and next time we'll talk about stock picking and also talk about options in the Q4. I'm not going to talk about it here. But this is the historic performance of the premiums. Now, what's a performance of a premium? Well, a premium is the expected return that we're going to get over another asset class. So in this case, it's the stock market, the U.S. stock market versus bonds. When are we going to get, or when does the premium show up historically? Over 1 year rolling periods, it's been 70% of the time. Now, we're not saying stocks have been positive 70% of the time over, in 1 year time periods. We're saying that stocks did better than bonds over a 1 year time period. 70% of the time rolling 1 year time frames. If we go up to 5 years, it's 78%, not that much better, a little bit better, 8% better. But we go from 1 year up to 10 years, then we get a 15% increase in the time periods that stocks have outperformed bonds in the United States. Okay, I'm not going to talk about the other premiums, but you can look at them if you like. And now we go to developed US or developed ex-US. So this is the developed countries outside of the US. If you invested in their companies in those marketplaces, if you invested in those markets. Only 63% of the time did you do better in a 1 year time period investing in developed markets. Over 10-year time periods, 94% of the time you did better investing in stocks than bonds in US currency. So we're talking about investing in dollars. So all of it's coming back to us in dollars. 94% of the time is pretty doggone good. Okay, now let's look at emerging markets. It's 66% of the time, again, in 1 year that their stocks have done better than their bonds. 83% of the time over a 10-year time period. So when we look at the three marketplaces, we see 85, 94, and 83% of the time, if you put $1 to work, really, you're probably going to have to wait 10 years. You could wait 5 years, and you very well could get a higher expected return, or higher actual return, I should say, but you're not guaranteed to. So if you're going to put $1 to work today, I know it's a lot easier to put dollars in U.S. markets. U.S. have gone up a lot more. But if you consider that in developed markets, yes, if you wait 10 years, you're probably going to get a higher return with stocks over bonds. And then emerging markets, probably 10 years, 83% of the time, you're going to get a higher return. Now, we don't know which markets are going to do better over which decades, but that's just something to think about, that when you put a dollar to work, don't check your smartphone this week, next week, even next year, because we really expect there to be positive returns over the long run. And if we have that type of expectation, I think we're just going to be a lot happier, quite frankly, just a lot happier. So here was the quarter. U.S. market up 1%. Developed down 1%. Emerging markets down 4.25%, much more volatile. And these are the average quarters in history. Global real estate had an incredibly good quarter, 5.72, and then U.S. bonds and U.S. stocks, global bonds actually doubled the U.S. stocks. So it was REITs and bonds that really had a great quarter. Over the longer period of time, a year, stocks were up about 3%, and I'm going to show you what that ride was in a second. And then developed markets were down, emerging markets were down over the last year, ending September 31st, 2019. Global real estate, tremendous. Bonds. So which did better over the last year? Back to my which does better every rolling period. Well, bonds actually beat stocks over the last year. Over the last 5 years, stocks beat bonds. Over the last 10 years, stocks beat bonds. So this shows that it's really hard to look at things in the short run. So Q3, a lot of bad news in Q3, a lot of bad news, I thought anyway. But the market was just kind of flat, the world market, that is. Okay, so when we look at the last year, I mentioned at the very beginning that there was a short period of time that the returns really showed up. In the last year, you had this period of time from September 30th until December 24th, where markets screamed downward. And then this is really where the markets screamed back up. The markets came down and then back up again, almost a V, if you will, almost a V. This looks a little like Texas, but almost a V. And then somewhere March 31st in April, the market hit a high. And then it went down, and then it came back up and went a little higher, and then came back down, and it was about even at the end of September. So most of the return came in the first quarter. And if you were not in the markets in the first quarter, you missed it. And that's what we've seen in the past. As far as which investments or which markets did the best, the REIT index, the U.S. REIT index was first, then REITs from outside the U.S. was second, and then bonds were third, and then the S&P 500 was finally fourth. The lousiest investments for the quarter were small cap emerging and value emerging, down a lot. Okay, so I'll quickly run through this. 55% of all world investment is invested in U.S. companies, and you can see the respective returns of these different asset classes, growth and value, and then small size. Small growth did the worst, down 4%. Small cap in general had a pretty poor quarter. International developed. These are developed countries that had their companies outside the U.S. 33% of all dollars invested go into the developed world's companies. A lot of good companies out there, like Novo Nordisk, Nestle, my old company, GlaxoSmithKline. These are global companies, but they happen to be located in the developed world. So you can see that in local currencies, all their markets were up. When the money came back to us in U.S. dollars, we actually lost on all these investments. That's why they were down 1%. And then emerging markets just had a poor quarter. 11% of all investment dollars are going into emerging markets. When will they return to glory? I don't know. But again, if you put some of your investment into emerging markets and you wait 10 years, I think you're probably going to get a higher return versus investing in emerging market bonds and maybe U.S. bonds. So here are the countries that did the best in Q3. If you chose Belgium, you can win a prize. Japan was second, and then the Netherlands, followed by the U.S. In emerging markets, it's Turkey, Taiwan, Egypt, and the Arab Emirates. Now, what's so interesting to me is that Turkey was up 11%. They were kind of starting a war, or had a war going on with Syria. And who would have picked Turkey? And then Hong Kong, actually, Hong Kong makes some sense with what's going on with China. So sometimes it makes sense, sometimes it does not make sense. And Poland was the loser in the international emerging market area. Currency was mostly was negative if you invested in foreign investments, and that's part of the reason why U.S. REITs had almost a 7% return, and ex-U.S. REITs had a 3% return. But REITs in general had a tremendous quarter. That's when the return showed up this year. Commodities, you can see that most commodities were negative. I'm not going to get into that. And the fixed income, it's still inverted. The yield curve is inverted. We won't go into that anymore. There are a number of yields around the world that are still negative. We have a video on negative yields if you're interested in watching that. And then this comes back to that 10-year idea. So you can diversify. You don't have to put all your eggs in one basket. If you're going to use dollars in the next 10 years, if you're afraid you might lose your job and end up having to dip into your nest egg, put that portion in bonds or cash or CDs or something else. Talk to us about that. This is a 75%, 25% portfolio. It did not do as well over the last 20 years as a 100% stock portfolio. But the ride was a little bit better. So, and that's, for some people, you got to be in it to win it. So the final thing is that timing, it says timing isn't everything. It's all about the time in the markets. That's the whole idea, the time in the markets as opposed to timing the markets. Now, if we could time the markets, we would love to. If we could find someone to time the markets, we would love to. But as many people have said, they don't know anyone that can time the markets. John Bogle said, I don't even know anyone that knows anyone that can time the market. You have to be right about 80% of the time. So if you put your dollars into stock markets, really try to think long term. I know it's not easy, but we're here to help. That's a really huge part of what we do. We help our clients think about the long term, plan for the long term, and then stay invested through thick and thin, and the returns will, again, I use the word probably, be positive. Thanks for watching.